Hi, this is Robyn and welcome to another in our FINbites series. And in this video, I'm going to take you through leasing definitions and try to untangle what the standard means with its definitions. I'm breaking it up into two videos for you. In part one, I'm going to look at the wording within the definitions, while in part two, I'm going to work through some numbers to show you how these definitions are applied. I'm going to be talking about a car lease in these two videos, as I think you'll have an understanding of how they work. So I'll take you through just the purpose of this series of videos. So the focus is going to be just on the key finance lease definitions, because that's the area where we tend to find on the discussion forum that you guys tend to have a lot of problems with when you're trying to work out your journal entries for lease accounting in a finance lease. I'm going to be looking at the definitions from the perspective of the lessee, and then also from the definitions, the perspective of the lessor, looking at those definitions. But I'm not going to be looking at journal entries today, because some other videos will help you with those, along with the activities and worked examples in Unit 12. So understanding these definitions is really critical in doing the correct accounting for the lessee and lessor. So hopefully through these videos, I'm going to help you to understand that what they mean and simplify these definitions for you. So if we look at a finance lease, I find it just easiest to think that a finance lease, effectively, it's a loan. The leasing company is just trying to help you to buy the asset. They lend you money at an interest rate. So it really is just like a loan. So the charge for lending you the money is the interest. Okay, so if we turn to IAS 17 on leases, we're going to start having a look at what some of these definitions mean and what are the critical ones to help us to work through the accounting when you take from this video and go and apply the concepts I'm taking you through. So firstly, in the definitions paragraph within IAS 17, it tells us that a finance lease is a lease that transfers substantially all the risks and rewards incidental to ownership of an asset, and title may or may not eventually be transferred. And so usually what we find with sort of a car lease is that the title eventually is transferred because the car dealership or the leasing company doesn't want your second-hand car on their hands. So if we think about the deal, so the finance lease agreement that you're striking. So again, let's look at this from the perspective of you leasing a car. So you go down to a car yard and you negotiate with the salesman and you agree on the price for the car. So that's the fair value that you're agreeing on. Then you might say, okay, I want to lease the car. So you don't have the cash up front to be able to purchase it outright. So you want to lease it. So the lessor, so like the car dealership or their own finance leasing company, will charge you interest for the use of those funds. And the amount of interest that they're going to charge you, the percentage they charge you, determines the value or the amount of the lease payments that you'll be paying back over the lease term. Typically for a car lease, it's 36 months or 48 months. In our examples and activities, we tend to do it in years because too many leasing periods just gets too annoying, but the principles are the same. Also, as part of the deal, the lease contract will specify whether you have to pay a residual at the end of the lease. Sometimes you might have heard this referred to as a balloon payment. So it's a bigger payment than, say, the monthly payments that you have to make, but it's something that needs to be paid at the end. So it's a residual. And lastly, both the lessee and the lessor may incur some costs in relation to establishing their lease. Okay, let's start looking at some of these definitions in IAS 17 paragraph 4. Now, one of the key definitions is that of minimum lease payments. And what you'll see is that this definition differs depending on whether we're looking at it from the perspective of the lessee or the lessor. So firstly, we're saying that minimum lease payments are the payments over the lease term that the lessee is or can be required to make. I'll miss those other bits because they don't affect us very often. Together with, for a lessee, any amounts guaranteed by the lessee or by a party related to the lessee, or, if you're looking at it from the lessor's perspective, any residual value guaranteed to the lessor by the lessee, a party related to the lessee, or a third party that's unrelated to the lessor that is financially capable of discharging the obligations under the guarantee. So what's that saying is, for a lessee, what must you pay? And if you've got any amounts that are guaranteed by a party related to the lessee, then any of those amounts as well. So if you had a subsidiary and it was going to sort of guarantee a payment, it's related to you, so you'd include that amount as well. So minimum lease payments is all about what you must pay, so what you've contracted to pay. And from the lessor's perspective, they're saying that the minimum lease payments include any amounts that a third party that is unrelated to them, unrelated to the lessor, that they may guarantee. So that's going to be very rare in practice to see that sort of third party type of guarantee. And then this last chunk of the definition says, however, if the lessee has an option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable, for it to be reasonably certain at the beginning of the lease that you'd actually exercise that option, then the minimum lease payments will comprise the amounts you pay over the lease term to the expected date of the exercise of this purchase option and the payment required to exercise it. Now, lots of words. Probably the easiest way of thinking of this paragraph is they're saying, if at the beginning of the lease term there's this amount that you can choose to pay, but it's going to be relatively small compared with the fair value of the asset at the time when you exercise it, then you're going to include that in your minimum lease payments, because effectively it's what we used to call a bargain purchase option. So if you, for example, if you could choose to pay $5,000 at the end of the lease, but you thought that at the end of the lease the asset would be worth $20,000, well, you're getting a bargain. So yeah, you'd be pretty stupid not to want to pay that. So if there's likely to be this bargain, then yep, you'd want to pay it. So therefore, that $5,000 bargain purchase, that option, will be included in your minimum lease payments because, hey, you'd want to pay it. Okay, so that's what we mean by minimum lease payments. Okay, then the standard goes on again in paragraph 4 where we find the definitions to give you definitions of guaranteed residuals and unguaranteed residuals. So remember, I mentioned earlier that for a car lease, this might be that final payment, the balloon payment. So it's just sort of explaining again what we saw in that definition of minimum lease payments, that for a lessee, it's amount that they must pay, that they're guaranteed to pay, or that a party related to them guarantees to pay. For a lessor, it's the amount that's guaranteed by the lessee, or that sort of unrelated party to the lessor that is financially capable of meeting those obligations. Whereas an unguaranteed residual value is the amount that the realisation of which by the lessor is not assured. So in any way, another way of thinking that is it's some sort of optional residual to pay at the end. So no one's being forced to pay it. It's not a contractual amount that has to be paid. So that's the difference between a guaranteed residual, and it's slightly different depending on whether you're the lessee or lessor, and an unguaranteed residual, which really only has application to the lessor when you do the accounting. And the last sort of bit that we'll look at in the definitions are initial direct costs. So they're incremental or additional costs that are directly attributable to negotiating and arranging the lease. So what extra costs did you have to incur to get into the lease? However, this definition excludes any costs incurred by lessors that are manufacturers or dealers, because those types of costs just end up being part of their cost of sales. Actually, we have one more definition that I want to take you through, and that's the interest rate implicit in the lease. Now, this is the definition that I think tends to cause most people challenges when it comes to the leasing unit. And it says it's the discount rate, it's an interest rate, it's a discount rate that at the inception of the lease causes the sum of the present value of the minimum lease payment and any unguaranteed residual to be equal to the sum of the fair value of the leased asset and any initial direct costs. Okay, doesn't mean all that much, so what I like to do is switch the definition around. So if I bring this definition together, let's see how they play a part in determining the interest rate. So we've talked about initial direct costs, the present value of the minimum lease payments, and an unguaranteed residual. So bringing together those ideas from the definitions, let's see how we can do a mathematical calculation to determine what the interest rate implicit in the lease is. So I find it easier if I switch the equation around. So on the left side there, what I find is that we've got a fair value that's been agreed between the lessor and the lessee. Remember my car dealership thing for the asset, they've agreed a price, and the lessor has incurred some costs in getting the lease drawn up. So that would be initial direct costs of the lessor. So that's the left side of my rearranged equation. Now, if the amount on the right-hand side of the equation over here, if the minimum lease payments are high, so if the lessor is saying, okay, under this agreement you have to pay a lot, then what that's really meaning is, well, they must be charging you a high interest rate. So, because remember what we're trying to do here is to work out what this equilibrium is. It's sort of like, what's the interest rate that causes the left side, the fair value of the leased asset at the beginning of the lease, plus those initial direct costs of the lessor, to equal the present value of those minimum lease payments, plus the present value of any unguaranteed residual. So you'll notice there it's only the unguaranteed residual, because any amount that was guaranteed would be in the minimum lease payments. Remember, minimum lease payments are what must have to be paid. So also it might help you to think of this interest rate from a practical perspective. The lessor operates in a competitive market. The lessor decides what interest rate they're going to charge to the customer, the lessee. So the interest rate then determines the value of the repayments that the lessee has to make on the right-hand side of this equation. So that brings me to the end of part one. So they're the key definitions that we've been looking at: minimum lease payments, guaranteed, unguaranteed residuals, initial direct costs, and the interest rate implicit in the lease. So in part two of the video, I'm going to take you through some numbers to show you how to apply these definitions in practice.